Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Indian equity markets have run up in recent times. Benchmark indices have hit fresh highs, while the broader markets too have shown strong outperformance. Now, is it then the right time to book profits? And is this the right time to perhaps rebalance your portfolio? And where should you deploy additional funds? Let's understand all of this. I have Arun Kumar, Head of Research, fundsindia.com with me. Arun, good evening and welcome to the show.
Hi, Kav.
Time to rebalance, a strategy maybe that one should be adopting in their portfolio from time to time. But then right now, what kind of rebalancing and revamping in the portfolio are we talking about? Obviously, a lot depends on the kind of goals you have lined up with. But then if one is really heavy in some department of equity, do you think it's time to just maybe book profits and deploy that fund somewhere else?
Yeah, so the starting point is fairly simple that whenever there is an all-time high, there is a natural sense of unease for most of us because usually you hear the fact that you need to buy low, sell high. So the moment that you hear sell high, you kind of tend to associate with the all-time highs. And generally, there's this unease that there might be a market fall after this. And you add to the fact that the last four times, almost for 1.5 years, the Sensex has kind of got stuck in that 60,000 band. So every time it comes to the 60,000 levels, there's a 10-15% correction. So we had four times where it touched 60, 62, then again it fell. So the same again, most people were expecting probably for the same pattern to repeat, but again it's overshot that. So the first level of understanding would be that the all-time highs are nothing to be worried about, because if you technically think about it, most of us would say I would expect say around 10-12% from equity. So let's take 12%. In other words, you are saying that the Sensex or the Nifty should double every 6 years. So that's what 12% actually means in terms of the actual the absolute returns, right? So which means you're saying 60,000 should inevitably go to 1,20,000. Let's say at 12%, you're in other words, you're saying in 6 years it has to go to 1,20,000. In another 6 years, it has to go to 2,40,000. So which means net, it is impossible for the Sensex or the Nifty to grow without hitting all-time highs. So for any growing asset class, be it gold or real estate or equities, all-time highs are a given. So the second most important point is we also did a simple analysis of the last 23 years. We found that on average, if you only invested in all-time highs, your average 1-year returns were close to 14%. And 50% of the times you made more than 15% returns after all-time high. So there is nothing to be really worried about an all-time high per se. And usually the way it works is that it gets stuck at all-time high levels for some point in time. Then it again breaks out, cutting a lot of all-time highs, and again the market. So this happened between 2008 to 2013. It was more or less stuck in the Sensex was stuck in the 20,000 levels. Then it shot up to 40,000 in 2018, and again it got stuck at 40,000 levels for probably 2-3 years, and then after that it's now at 60,000. Probably the next level will be much higher. So overall the breakouts happened, but we
Yeah.
don't know whether this is a breakout or not. So
So
there
clearly
is
there
nothing
is
to
no time to
yeah,
even time the profit taking part
correct,
also, right? So how can
right.
one go about it then?
Yeah. So broadly, the idea would be that do not try to come out or get in based on the all-time highs. I think a simple idea would be that whatever is your asset allocation, say you are 70% equity or you might be 50, just make sure you give it a band of plus or minus 5%. So right now, because of the market moves, if you are say at 76 or 77, maybe you should bring it down to 70. But if you are say instead due to the market rise, you're only at 74%, still not broken that 5% cutoff, you can continue with the existing allocation. So my sense is give it a 5% band, and as it is not exceeding your original allocation by 5%, you don't need to rebalance. If it exceeds, move some equity and then bring it back to debt. One is that. Other thing how you can do it is the incremental money, if you have your SIPs coming, put it more towards debt so that overall you bring the equity allocation back to the original. So these are two things that you can do.
So you are suggesting that one can increase the amount in debt by booking profit from their equity portfolio. But then what about reinvesting it? One should be doing it from debt itself now?
So again, the concept is fairly simple that you look at what your current allocation is. So let's say you started with the intent that you have to maintain around 70% equity. Right now, if it is exceeding that by 5%, then alone rebalance it back. But if not, you can still continue with the original high. You don't need to make any incremental changes. This is not the time to go either underweight on equity or overweight on equity. So in that sense, if at all your current equity allocation has probably moved up to 76 or maybe cut the 5% or more, that excess allocation of the 5 or 6%, you can move it into debt right now. And if you have incremental allocations, you can realign in such a way that majority of it goes to debt, so that overall it brings that 76% of equity slowly back to the 70%, but don't go below 70%. So don't go underweight, but just make sure that you are just rebalancing it back and building it close to that 70%. I'm saying for an example, it can be 50 or it can be 30, depending on what that current asset allocation split of that investor is.
So, Arun, are we also talking about within equity? Are we also applying the same rule maybe to book profit from mid cap, small caps?
Yeah, see, we are not in the camp that you will have to currently go underweight on mid caps or small caps. Generally, we've at a core portfolio level, we use the small caps for us internally. So we use small cap only as a tactical portion. So broadly, the way we kind of approach is that within equities, we look at it in terms of 5 different buckets. So the first bucket would be the growth at reasonable price style. And then the second style would be the value or contrarian style. The third would be the quality style. The fourth would be mid and small cap bucket. And the fifth would be the global bucket. So as long as you are 20% in each of these buckets, I think overall you have a good diversified portfolio. So if at all you are in excess in one of these styles, or you have too many funds, or you have an extreme overweight in, say, a particular AMC or a particular fund, then this is probably a good time where you can simplify your portfolio and kind of get it diversified across the 5 different styles. So I think this is a good time where you can simplify your equity portion.
And what about across asset class? I mean, equity, debt, we've spoken about, but then what if you have other asset classes also in your portfolio?
So broadly, the way we kind of look at it is that equity will be your asset class, which kind of gives you good returns over long periods of time. But again, comes with the volatility that 10-20% is a given every year, and a 30 to 60% is kind of to be expected every 7-10 years. So gold and debt is more stable. Gold is more like an anti-equity portfolio, where like generally when there is a crisis or equity doesn't do well, gold tends to do well. So overall, my sense is whatever is your starting allocation, say you are 70% equity and another 20% into debt and say 10% into gold, you can continue that same 5% band and make sure that all these 70 is within that 65 to 75. Similarly, debt is between 15 to 25. And again, gold is between, say, 5 to 15%. So if you maintain that, if there is any break, I mean, anywhere there is a deviation of more than 5%, you can either reduce or increase based on that. So I think overall, at different asset allocation, if you can keep this simple band, it should more than be enough at the current juncture.
All right, I think that will be all. Thank you so much, Arun Kumar, for being on the show and helping our viewers with their rebalancing strategy for the portfolio today. Thank you. We take a quick break, but then post that, let's talk about missing out the opportunities to participate in the market rally. Are you one of them who really feel the FOMO? We'll discuss all of this with Kaustubh Velapurkar after this break, and also get your mutual fund portfolio queries answered by him.